Hi, this is James Eng with Full Capital, and for this month's multifamily webinar, I'm titling it "Fear" for June 2024. So let's jump into it. So this fear comes from KKR's head of real estate in a recent article they put together and said the once in a decade opportunity for real estate equity investors is complex but also exciting, and it's time to start thinking of fear as a friend. And so we'll dig in a little bit more into what he's saying in that article. And there's a lot of fear in the market right now. And when it comes to buying a property, putting a deal under contract, and getting it closed, it is not easy right now. So in today's webinar, we're going to cover sort of market headlines, what we're seeing out there, in terms of what's happening in the market. And then also diving into the second piece is really going to be, I'm going to focus in on DFW and sort of what has closed in the second quarter of 2024. And then we'll get into some of the broker reports from Newmark, Marcus Millichap, Yardi, in terms of what happened, sort of Q1 data, and then talk about what's going on in the financing world. And then if you want a copy of this deck, you can send me an email here below, is my email. And then also, if you're looking at transaction data for a specific market, feel free to email me. I focused in on DFW for the second quarter in this webinar, just in terms of time, but just wanted to give you general themes that I'm seeing out there. So let's hop into the market headlines. And this article came out in about April from KKR, and basically the title was "When Fear is a Friend." And from their perspective, they're seeing that US multifamily, yes, it is down, pricing is down, but it is not really a overall issue in terms of, it is more just a moment in time that it is down, and that the overall economics of multifamily, in terms of people wanting to have a place to live, and then also the pricing of multifamily, is the right business model to be in, and they are going to double down, which we will see very shortly. So in the article, they really touch on two main uh, topics. One is, people who bought in 21 and 22 on bridge loans, they are essentially deleveraging, right? So you were at 80% loan to cost on a high value on a 3 or 4% cap rate, and now you're having to come in and basically delever that deal and put down an additional 20%, right? So you got an 80% loan right now. You can only get about 60% loan on Fannie and Freddie, and so you're having to put down an extra 20%. So that's issue number one. Issue number two is that there's a ton of supply. So the amount of supply that is coming online across the nation, especially in the major markets in Texas, is very difficult to push rents right now. And so you're seeing a lot of concessions in the market, and they see that as temporary, though, and that overall there is a shortage in US housing. And so the people who are going to benefit are really people who can carry the next couple years. So we're in 24. The next couple of years are going to be a little bit tougher, but you're going to have to buy the interest rate cap. You're going to have to work through concessions and get to the other side of this. And at the other side of this will be rent growth. It will be lower cap rates and an opportunity to sell your property for more than it's currently worth today. And the people who are well capitalized, so the people who have money ready to go, they can buy high quality properties right now at a discount to replacement costs, which is, to build it brand new. And so they are very comfortable, very bullish on multifamily. And the one thing that they said was they have not seen is that would materially impact multifamily is a severe downturn, which to me, that's unemployment going from 4% to 8% or 10%. A huge increase in unemployment is going to materially impact multifamily, and that has not happened yet. So in terms of the economics of multifamily, they are still very good. So KKR very bullish. And then on the back of that, just this past week, KKR buys a $2 billion portfolio from Lennar, which was, I guess, Quatera. was so they bought 18 properties for $2 billion, and so I think it was around 400,000 a door, so pretty much brand new, top of the market deals, so Class A deals, and then last month Brookfield also bought close to $1.5 billion, 1.5 billion, 7,300 units, also across the Sun Belt from Starwood, and then uh, well, Blackstone bought a huge portfolio at the I think it was April or March of this year as well. So institutional guys, the institutional money is back in terms of if you're waiting for this capital to come back, it is back buying multifamily. We have not seen, sort of this buying signal for the last 24 months, probably going back to Q4 of 2021 when a lot of institutional money was buying portfolios. So if you're waiting for the institutions to come back, it looks like they're back. Um, you know, and why are they back? I mean, if you look at, so on the left-hand side is really CoStar's tracking a multifamilies index, and you can see sort of their value index, sort of this huge run up. So I sort of started in like 15 or so, and it was pretty steady rise up. So steady ascent from 15 to maybe 20, and in 21 and 22, it just went from, let's say on this index, 300 to 400 in less than a year and a half, 2 years. It's come back down last year, and then even this year, and then this is another Green Street pretty much had it in the Great Recession. They had 29% drop in apartment values, and they show it at 35% down from the peak. So that's sort of where these guys are tracking, and that's why I think some of these guys are stepping in. It's like, look, there's not another 35% to go, especially on A-class properties, and so that's why they're stepping in right now. It was hard. There was a lot of fear in the market in let's call this summer of 2009, and these guys, this is why these guys are stepping in right now. So. In terms of deals that have closed in the second quarter, this is a snapshot of the deals focused in on DFW, 50 units and higher. So it was about 35 properties that closed in DFW in the second quarter. And, I put the loans for these deals that I could find out there. And you could see just, let's say out of these properties right here, pretty much all of them were either Fannie new loans or loan assumptions, one bridge on here. So pretty stabilized. And the next set, most of them loan assumptions, Fannie, Freddie. Some of these larger ones were life insurance loans, one bridge loan here. And then, going to the third page, we have a couple. So these two deals, the Griffin and the Madeline, were deals. You see the submarket, East Fort Worth, which is a tougher submarket here in DFW. Two foreclosures. You can see the occupancy at 70% on this one. So that's where the lender took the deal back. They were bridge loans done probably in 21, 22. And, for whatever reason, they couldn't buy an interest rate cap or didn't buy an interest rate cap. And so now they're underwater and just had to give the property back. But majority of these deals are still getting done with Fannie and Freddie, whereas I would say probably 70-80% of the market is Fannie Freddie, and then 20% is maybe non-recourse bridge. If the deal, for some reason, 75% just can't qualify in terms of occupancy right now. And then some of these other deals we're doing loan assumptions, Fannie, Freddie. This group typically does non-recourse bridge, so they've been doing more non-recourse bridge, floating rate, and just buying it in the money cap. And then more loan assumptions, and this one is a student deal with recourse bank loan, and then non-recourse bridge. So, I think a lot of, compared to Q1, a lot of deals still got done in Q2. I mean, 10-year Treasury was hovering around probably 425. And so deals pretty much got done around 6% to 6.5% in terms of fixed interest rate, depending on term, depending on, the strength of the borrower, and then also the affordability of the deal. But, we're starting to see the distress come through. Tides had a deal in East Fort Worth that got foreclosed. This was a large deal, $103 million loan in Austin. that is was slated for foreclosure. I don't know if it's going to go through, but pretty much like even the property manager wasn't getting paid on that. A couple other deals, San Marcos, Austin, even here in Dallas and San Antonio, we're seeing foreclosures on deals on the bridge side that people just can't support. I mean, they bought out of 4-5% cap, and now the interest rates are 8-9% on these deals. And if you can't afford the new interest rate cap at 2 to 3% of the loan amount, then you're having to give the keys back to the lender. And then this was one more slide just on Houston multifamily, two deals that Arbor had to foreclose on. It's essentially the same issue. I mean, bought in 21, 22 on a bridge, floating rate. And what happens after the lender takes the deal back? Some lenders are able to they're just going to sell the asset, like they're not in the business of holding real estate, and others they'll hold it for a couple of years, then take it back out to the market. So this one got foreclosed, and then it's back out on the market. And the listing brokers who sold these deals in 21 and 22, they got them back out to sell the deal, except instead of the owner, it's the lender right now selling the asset. So let's move into what Newmark was seeing across the first quarter and sort of the economics of multifamily right now. And this is probably besides institutional capital coming in back into the market, this is probably the second thing that is favoring multifamily more so on the Class A side than anything else, is that the people who usually, they got to 30, 35 and, they want to move out and buy a house, it's too expensive. It's just the price of the house is high, the mortgage rate is high. And so this gap between, I mean, this goes back to sort of 06, 07, is significantly higher to go out and own a home versus rent a house or rent an apartment. And so this gap of $800-900 came down a little bit. I guess rates came down a little bit, but it's still pretty expensive. So, a lot of REITs were saying usually it's 15-20% of their tenants move out to buy a house. Right now it's in the single digits for a lot of them. A lot of demand has come back in the first quarter in terms of absorption. So a lot of units are coming online, but then a lot of them are getting absorbed right now. And then, this was third quarter of 2024. So the next two quarters are the peak for new supply hitting the market. And this is, percentage of inventory is 3.5%, which is high for a market, but then it's very concentrated by MSA. And so what you'll see is vacancies are going to continue to increase, and then also rent growth essentially across the board. We had this huge spike in rent growth, 21 and 22, but now we're seeing basically flat rent growth across the board. And if you look at the major Texas markets, pretty much all of them are negative right now. Austin, San Antonio, definitely the lowest. And so what we're seeing is on new leases year over year, you're getting a negative trade out, but there's still organic rent growth within the renewals right now on these. So, but just to give you a feel for how high we were in terms of Q4, I guess the top Q4 2021, 160 billion in that quarter. And then the first quarter of this year, 20 billion. So it has come to a screeching halt. I think it's probably back to 2013 or 14, or I can't remember in terms of originations that they had on the chart, but the number of deals is down significantly from where we were. And then, what's going to pick this volume back up is really, all right, we got a lot of maturities coming up, and people are going to have to do something. And so most people are trying to kick the can at least a year here by buying an interest rate cap. But for the people who cannot, really probably sitting in this debt fund bucket. So the people who are on agency with maturities, probably not a big deal. People on bank, it could be an issue because you've got to reset your rate. But then also this 40 billion in debt fund, 36 billion in debt fund usually those are shorter term maturities on floating rate. And so you're having to put up additional money to buy an interest rate cap or pay down the loan. All right, so that was Newmark. Let's move over to Yardi. So Yardi tracks all these multifamily properties across the U.S. And a couple highlights from their webinar. They focused in on uh, definitely the rents are decelerating, so flat rent growth like we saw earlier, and then some of these other markets where there really isn't a lot of supply, those are outperforming. So people are a little bit concerned on the inflation front. Like the shelter component of inflation has been running sort of hot, and people keep thinking, all right, once that comes off, then CPI and everything will be lower. But some of these markets in the Midwest, Northeast, mountain states, the rent growth is 3 to 5%, and so people are a little bit afraid that inflation is just going to keep increasing there. But they said, look, nobody's really building in terms of new supply right now. So it's going to be significantly reduced 26 to 29, and that's going to support healthy rent growth. But they're starting to see distress, of course, like we saw before on the foreclosures. And then they think transactions will pick up once rates come down over the course of 2025. All right. Okay, here's some rents. So I mean, I like this graph just because you can see sort of how far we've come from 2021. Average rents nationally were about $1,400, and then they increased about $300 in like 2 years. And so it has been flat, I would say, the last 12, 24 months, but just people are just absorbing that increase. And so even in a lot of rent rolls, even if you've done, 5% increases on your renewals, you're still like down here, so you're still below market on a lot of these deals. And so what we're seeing is negative rent growth year over year on the new leases, but then on the renewals, we're still seeing positive rent growth. Overall, new construction is down. They're expecting it to be slow for the next 12, 18 months, just until inflation slows down. And then the same thing with the mortgage rates being above 7. Just the first time home buyers just don't have enough money to go out and qualify for these homes. And also a lot of developers where they develop into the market, and now they had a construction loan, they can't refinance the Fannie and Freddie, and so they're going to have to just sell the deal. And they're not meant to hold these properties for a long time. Same thing about short-term loans. And then in terms of markets, they sort of hovered in on, all right, where the market's most at risk because of the amount of bridge loans and the amount of transactions done in 21 and 22. They had Atlanta, 12 billion, Dallas, 8 billion, Denver, 7, Houston, 6, and Chicago. So, a lot of these high percentage of loans maturing over the short term and having negative rent growth, they've focused in on Houston and Austin having a larger percentage right now. And then this last brokerage report really was from Marcus Millichap, and we're going to focus just in on DFW and the major markets. So start with DFW. I would say they had cap rates at about 5.2%, which they're saying is the highest since 2019. So I guess it's come up quite a bit, and then Class A deals are the greatest share of the trades right now. So it seems like Class A deals haven't been under as much distress, number one. And then, the people who are buying these deals, they just have shifted away from more B and C and more into A minus deals. Austin, I mean, there's still a ton of population growth going into Austin, but it experienced the largest rent decrease of all U.S. markets. And just the amount of supply, I don't think it has on this market report, it has 26,000 units for 2024, which is about 9% of the inventory, which is a huge number. You usually want to be about 2 to 3% of the inventory. So Austin is a smaller market than DFW or Houston, and it's just a big number for Austin to absorb. Houston, they're seeing the velocity come down, and then they probably have the highest cap rate. So they're at about 6% average cap rate down in Houston. And then San Antonio, the highest vacancy rate across the board. So their vacancy is almost close to 10% in San Antonio right now. So it is a smaller market, but it seems to just have a structurally higher vacancy than the other markets here in Texas. And so here's a snapshot across all four, which I thought was interesting. Pretty much the rents come back in DFW and Austin in 24 is their projection. Austin, I'm not sure about that, but DFW is probably flat, Houston flat, and San Antonio flat. And then you see the vacancy for San Antonio up there close to 10%. And then your cap rates, DFW and Austin about the same, but then San Antonio a little bit higher, 575, and then Houston above 6. And so when you're looking across markets, I think that's a thing to keep in mind is that a B deal in DFW or Austin is not the same as a B deal in Houston. So just keep that in mind when you're looking at price per door. Move over to the Fed funds forecast. I mean, it seems like everybody tracks this nowadays, but people are still projecting one cut in September, November timeframe, and then potentially one more cut in December. But you'll probably be around 5% at the end of the year unless something materially changes on inflation. So pretty much everybody has to buy this 1 year interest rate cap, and the caps cost about the same as you prepaying the interest for the whole year. So you buy a 2% strike, which caps SOFR at 2, you basically pay 3% of the loan amount. So that's pretty much baked in. 10-year treasury has been hovering around 425. I mean, this sort of middle of June came down. It's popped up a little bit at the end of June. But I think probably 4 is where people start. This is probably where a lot of deals got set is February, March timeframe at that 425, and then they closed in the second quarter. So a little bit more volatility in April and May. So that maybe hampered some transactions from getting done in the third quarter. But everyone's hoping that it comes down with the Fed cuts as well. But just my background real quick, born and raised in Houston, went to school at UT in Austin, and then was an underwriter across CMBS and balance sheet for GE Capital till 2015, and then have been focused in on multifamily lending since 2015, really across the 4 major markets in DFW or in Texas. So here's we'll get into what we're seeing across the lending markets. And we're seeing banks at about 8 to 9%. Freddie SBL has come down a little bit, 6.75. Freddie and Fannie about 6% plus or minus 25, and then non-recourse bridge about 8 to 10%, just depending on the spread. We have been getting some bank loans done. They are expensive and they want you to bring deposits. So they are not doing a deal. So a lot of times, Fannie or Freddie, they want 10% liquid from the guarantors. So 10% of the loan amount liquid. And, you can put that wherever you want. Fannie and Freddie don't want your deposits, but the banks, they want, if you're doing a $5 million loan, they want 500,000 in deposits at their bank. So they don't want you to keep it at Chase. They want you to keep it at their bank. So they're focused on building relationships, and they build relationships by holding deposits. So if you're looking at deals that maybe are distressed, maybe need a little bit of work, then the local bank could be a good option. Freddie Mac SBL, this is really from million up to 7.5 million. And this is for stabilized deals that are already 90% occupied. And you're looking for longer term. You could be coming out of a bank loan. You could be coming out of a bridge loan. Freddie Mac SBL 675 is what we're seeing, depending on what your location of the property is, what market it's in. And we can quote that pretty easily. Freddie Mac conventional is 7.5 and above. We're seeing probably a little bit tighter. So probably 5.5 to 575 for your larger deals, and that are a little bit more affordable. So I would think class B and C deals. And then Fannie, same thing, 575 to 625. And then affordability will help you get lower spreads on that. And then non-recourse bridge, anything that really can't qualify Fannie Freddie and you don't want to take recourse, you end up at non-recourse bridge, typically 5 million and above on those deals, and then you're gonna have to buy a cap a lot of times to make the deal work. So build that into your closing costs at probably 6 to 7% of the loan amount to buy a 3-year cap right now. All right, here's some of the deals that we closed in 2023. We closed about 550 million in 2023, about the same for the 2024 coming up. Mostly Fannie Freddie agency stuff, similar to what we're seeing closed across the market. And then, YO Capital, whether it's the podcast, whether it's webinars, speaker series, lunch and learns, we help you throughout the entire process, whether you're a buyer, whether you're a current owner, to find the best deal for your debt. And then our next big event for, we'll probably have 400 or 500 people here in Dallas at the Old Capital Conference, October 9th and 10th. We're hosting it at the Bush Institute, which is right at SMU. Super nice venue. So go to oldcapitalconference.com and you can register right there. And then, in terms of next steps, definitely like the video, comment on the video, what you're seeing out there. Share this video if anyone you think is interested in multifamily here in Texas. And then if you need help with an upcoming loan maturity, refinancing a deal, or looking at a deal to invest in, feel free to send it to me and we can set up some time to talk about the deal right there. All right. Thanks a lot, guys.